Hey everyone, and welcome back to the channel. We've journeyed through the 6 key professions of trading, from being a market analyst to a strategist. But today, we're tackling the final, and arguably the most crucial, piece of the puzzle, profession number 7. This is where it all comes together. We're talking about being your own fund manager and your own psychological coach. You could have the best strategy in the world, but without mastering these two roles, long-term success in trading will always be just out of reach. So, if you're ready to elevate your trading game to the next level, stick around. This is the one you can't afford to miss. Let's start with the first part of this dual role, being a fund manager. What does a fund manager actually do? Well, at its core, it's about managing risk. It's not just about making money. It's about protecting the money you already have. This is what we call capital management. Think of your trading capital as your business inventory. If you mismanage it, you're out of business. It's as simple as that. The first rule of fund management is the famous 2% rule. This principle states that you should never risk more than 2% of your total trading capital on a single trade. Let me break that down. If you have a $10,000 account, 2% is $200. That's your maximum acceptable loss for any one trade. Not the amount you invest, but the amount you're willing to lose if the trade goes against you. This is determined by your stop-loss placement. Why is this so powerful? It's about survival. Even if you hit a nasty losing streak of 10 trades in a row, which happens to even the best traders, you've only lost 20% of your capital. You're still in the game. You have enough capital left to recover and keep trading. But if you were risking 10 or 20% per trade, just a few bad trades could wipe you out completely. Another key aspect of being a fund manager is understanding risk-to-reward ratios. A good fund manager never enters a trade unless the potential reward is significantly greater than the potential risk. A common benchmark is a 1-to-3 risk-to-reward ratio. This means for every dollar you risk, you're aiming to make at least $3. So, if your stop-loss is set to lose $100, your take-profit target should be at least $300 away. The math is compelling. With this ratio, you only need to be right about 25% of the time to break even. If you can win just 30 or 40% of your trades, you become consistently profitable. This isn't about having a crystal ball, it's about playing the probabilities in your favor. As your own fund manager, you also need to track your performance meticulously. This isn't just about looking at your account balance. It's about keeping a detailed trading journal. Every trade should be recorded. The entry price, the exit price, the reason for the trade, the risk-to-reward ratio, and importantly, how you felt during the trade. This journal is your performance review. It will highlight what's working and what isn't. Are you consistently making money on certain setups? Are you losing money during specific market conditions? Your journal holds all the answers and is the key to refining your strategy and improving your execution over time. It transforms trading from a guessing game into a data-driven business. Now, let's move on to the second, equally important role, being your own psychological coach. Trading is one of the most mentally demanding professions on the planet. The market will test your discipline, your patience, and your emotional control every single day. The two biggest enemies of a trader are fear and greed. Fear can make you exit a winning trade too early, leaving profits on the table. It can also paralyze you, causing you to miss perfectly good trading opportunities. Greed, on the other hand, is just as destructive. It can tempt you to over-leverage, to risk too much on one trade, or to hold onto a winning position for too long, only to watch it turn into a loser. So, how do you coach yourself through this emotional roller coaster? It starts with self-awareness. Use your trading journal to not only log your trades, but also your emotions. Were you feeling anxious when you placed that trade? Were you feeling euphoric after a big win, leading you to make a reckless follow-up trade? Recognizing these emotional patterns is the first step to controlling them. When you see a pattern of revenge trading after a loss, you can create a rule for yourself. after a significant loss, step away from the screen for an hour, or even for the rest of the day. This creates a circuit breaker for your emotions. The next tool for your psychological toolbox is having a rock-solid trading plan. Your trading plan is your rule book. It should define everything: what markets you trade, what time frames you use, your exact entry and exit criteria, and your capital management rules. Your job as a trader is not to predict the market, it's to execute your plan flawlessly. When you have a plan, you remove the guesswork and the emotional decision-making. The market is chaotic, but your actions should be systematic and disciplined. Before each trading day, review your plan. When you're in a trade, trust your plan. After the trade, review your execution against your plan. This builds discipline. Another critical part of being your own psychological coach is managing expectations. You will have losing days. You will have losing weeks. Even the most successful traders in the world do. The goal is not to win every single trade. The goal is to be profitable over the long run. Don't get discouraged by a single loss. View it as a business expense, a part of the process. Similarly, don't get overly excited by a single win. Stay neutral. Stay focused on the process of executing your plan, not on the outcome of any individual trade. This mindset shift from short-term results to long-term process is what separates amateurs from professionals. To wrap it all up, mastering profession number 7, the dual role of fund manager and psychological coach, is the ultimate key to unlocking your potential as a trader. Your capital management rules are your shield. They protect you from blowing up your account and ensure you can stay in the game long enough to be profitable. Your psychological control is your compass. It keeps you disciplined, patient, and focused, preventing your emotions from sabotaging your well-laid plans. These two roles work hand in hand. Good capital management reduces stress and fear, making psychological control easier, and strong psychological control ensures you stick to your capital management rules, even when greed or fear try to take over. So, take this seriously. Write down your capital management rules. Start that trading journal today and be honest about your emotions. Create a trading plan and commit to following it with unwavering discipline. It's a continuous process of self-improvement and self-mastery. This is the final and most important profession of trading, and it's the one that will truly define your success. Thank you so much for watching this series. I hope it has provided a comprehensive roadmap for your trading journey. If you found this valuable, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our future content. Let me know in the comments which of the 7 professions you're focusing on right now. Stay disciplined and happy trading.